Hi, everybody. Welcome to Parallel Systems. I am your host, Mike, and on tonight's show, we are going to be exposing some of the biggest frauds in the investing space. People who know absolutely nothing about gold. As you all know, gold is up over 40% this year. It's been climbing for 25 years straight, outperforming property, outperforming the stock market, outperforming bonds. It is, in fact, the best performing asset class over the last 25 years since the dot-com crash, after which they completely eviscerated the currencies to give you the illusion that your investments are going up when they're not. It's all created by funny money, but of course, the more money they inject into the system, or should we say currency, the weaker the currencies get, and therefore gold goes up even faster. That's what we've seen for 25 years. But there are some big shysters out there who will tell you that gold is a pet rock, gold is a terrible investment. So tonight, my friends, we're going to be exposing the biggest idiots in the investing space who have lied to you for too long about gold. Let's go to our first moron. It is Mr. Dave Ramsey, the mega mogul in the US who supposedly is a wealth preservation expert. But he does not like gold. In fact, he hates the stuff. Let's see what Dave Ramsey has been telling his listeners over the past decade about gold. Okay, my friends, let's start with this video. Why you shouldn't be fooled by gold buying headlines. This is from May the 2nd, 2023. And as you can see, The Ramsey Show has 4.41 million subscribers on YouTube. So this guy's giving a lot of people a lot of advice, and his advice here is on gold. So let's see what he's got to say about gold.
I'm over 70 years old. So in about a year and a half, 2 years, I'm going to have to start taking cuts from my 401k.
So let's just stop there for a second, guys. This man who's calling in is over 70 years old. When you are going into retirement, your investments should have long since shifted towards the safest assets possible. Why? Because if you are exposed to the stock market at age 70 and the stock market collapses 90% like it did in 1929, or it collapses like it did in the GFC by 50, 60%, depending on what stocks you're in, then you're going to retire with nothing. So you should be in safe investments by 70. Gold is where you go to protect yourself from counterparty risk, from the risk of the stock market collapsing. So this guy should be told that gold is a great place to preserve his wealth. But I'm pretty sure that's not what old Davy boy is going to say to him. Let's continue.
Automatic payouts. The government makes you.
Yeah, your required minimum distribution. Yeah.
Right. I don't use that money. It just sits there. It was making money under the Trump administration. It's kind of losing money right now.
Yeah, notice
but
that.
Anyway, I don't really know what to do with that money because I don't need it. But my gut feeling is to invest it in gold.
No.
Whoa, Kevin there had a fantastic idea. His gut was telling him what to do, but he called up the expert. Look at this guy on the left. He knows that Dave's about to bullshit, so he's looking a little bit nervous. I think his diaper's getting full. And Dave looks like he's filling his diaper right now. But let's see what Dave had to say. He said no, so I wonder what he's going to tell this guy to invest in to protect his wealth age 70.
And you want to let it sit somewhere, let it sit in a good mutual fund. That's fine.
That would do better than gold?
Oh, absolutely.
Oh, absolutely. Well, gold since the year 2023, when this episode was recorded, let's remind ourselves it was May the 2nd, 2023. Gold since that point is up about 87%, I would guess, 87% based on where we are today. The gold price is currently $3,684. Mutual funds will give you around 9%. So let's be generous to Dave and say 10%. You could have got 20% with Dave Ramsey's advice, or you could have put it into the pet rock, as Dave Ramsey calls it, and Warren Buffett, who we'll be coming to, and got yourself nearly 90% returns. So sorry to Kevin from Corpus Christi. You are one of Dave Ramsey's victims, unfortunately, when it comes to his really bad gold advice. But I've got more. I've got another one here. This guy is from 2020. This one's called Cash in Savings Bond to Buy Gold. Let's see what Dave had to say to this poor fellow.
Thank you, Dave. Nice talking to you.
You too.
I've listened to you for a long time. This is the first chance I've had to call in. Your knowledge is amazing.
Thank you.
Really enjoy listening to you. Now I'm going to spring the question on you that I've been wanting to ask. I've got some U.S. savings bonds. They're locked up, and I am thinking of exchanging them and buying some gold coins.
Mm-hmm.
Is that a good move or a bad move?
Paul, it was a fantastic move if you'd done it, but I've got the feeling that you didn't do it because you called up the Dave Ramsey show and got some fantastic, stellar advice from this so-called financial expert. And look at Dave's face. He's like a bulldog with a wasp in his mouth. He's got his arms folded. He doesn't look very comfortable anymore. His diaper is certainly soiled. Let's see what advice he gives.
You have not been listening to us a bunch, I guess, just off and on periodically.
Well, yeah. You tell me. Why?
You never heard me address gold before.
Pardon me?
You've never heard me address gold before?
Not really, no.
Oh, okay.
That's
okay.
what I've been listening for.
That's what I was trying to check on. Okay.
I like the way that one of the first things that Dave does when his caller asks about gold is try to belittle them, try to make them feel foolish for even asking the question. No, your callers clearly know more than you, Dave, and I don't know how you got super rich. I'm guessing you're in some special club. You're definitely in the anti-gold club, but I've got a feeling you're in other clubs too. Now I'm going to see what advice he gives to this guy. Remember, this guy sat in US debt. He sat in treasuries. Treasuries in 2020, that was the time to get out of them because what happened after 2020, we got massive amounts of inflation and bond yields started to rise rapidly. This was the best time to get out of bonds and into gold. But here we go. Let's see what Dave had to say to the guy.
So I don't buy gold as an investment ever.
Because you're dumb.
And the reason is very simple. It is a commodity.
No. Dave, this is one of the dumbest things that I have heard you say in the last 5 minutes. And you've said a lot of dumb things since I started looking at your videos, but this was one of the dumbest. Gold is not a commodity. Look at central banks. Central banks ain't holding vaults full of wheat. They ain't holding vaults full of lumber and timber. They ain't holding vaults full of lithium or oil, but they do hold gold. Is that because they hold commodities as reserves or because they hold money as reserves, Dave? Think about it, buddy. Think about it.
Its value increase or decrease is not tied to anything except a shortage or an overabundance.
No, it's not. The value of gold increases as the system decays and currencies are debased. And if you want to see that very clearly, look at gold from the year 2000 to today and compare it to the stock market. In fact, compare it to housing. In fact, compare it to any asset class. Over the last 25 years, gold has outperformed every single one. If Dave Ramsey knew what he was talking about, that's precisely what he would say. But he doesn't say that because he's either lying or he doesn't know.
Times like this, when there's fear, or in times when there's greed, gold prices go up, but nothing causes that to go up except just scarcity. The only thing, and that's not true with a financial instrument like that actually generates money, like a stock does, or like a piece of real estate does. They actually generate money. And
well, again, sorry, Dave, to interrupt, my friend. You've got egg all over that head again, but that's not true. Real estate has not been performing since the year 2000. In the year 2000, you could buy the average priced British house for 570 ounces of gold. Today, if you sold the average priced British house, although nominally the price has gone up, you'd only get around 180 ounces of gold. Why? Because that house has lost value in real terms. It's gone up nominally, but in real terms, it's collapsed in value versus real money. Which is gold the same as the S&P 500? Dave, I've seen enough. Okay, let's go to the next one. You can see his studio has certainly had a revamp over the years. That's because he's earned a lot of money, clearly, by giving people bad advice. 305,000 views on this video. This was from April the 11th, 2016. Let's see what he had to say to Gary in Mesa, who, again, looks like he's asking about gold and silver this time.
It is it a good idea to invest in gold and silver, like a Roth IRA? And I don't know if it's a good thing. I think it's tangible, so that's my question.
It's what?
I like how Dave wasn't even listening to the guy. He just didn't give a shit. Just sat there on his laptop looking at Pornhub, and then he's like, what did you say? Why did you call in? What's going on? Who am I?
I think it's tangible, so that's my question.
It's what?
it's a solid piece. Is it a good idea to invest in gold or silver?
No.
No, it's not. Well, I'm going to show why. Again, this is terrible advice, Dave. We're calling you out, buddy.
Here's a couple problems with gold and silver. One is anytime you're analyzing an investment, if you're buying a piece of real estate or you're buying a stock, which I don't buy single stocks, but you could look at a single stock, or you're looking at a mutual fund or whatever, any kind of an investment you're putting money into, you can look at, and you should look at its track record, what it's done in the past, to get an idea of what it's worth today. Okay. And to get an idea of what it's going to do, in the future. And, if you look at gold prices, I just pulled them up. They are all over the place. And up.
The gold prices are all over the place. You mean like every single other financial asset in the world? That's kind of what happens, Dave. Nothing goes up in a straight line. Look at the stock market from the year 2008. No, in fact, let's go back even further. Let's look at the stock market from the year 2000 to 2008. Guess what? It went nowhere for 8 years, and then it collapsed again in 2008. So if you bought the peak in the year 2000, you went nowhere for over a decade. Well over a decade.
Down, up and down, and right now they're way down again after an all-time high. And when you look at the track record, say over 50 years, if you put money in gold 50 years ago, or you put money in a growth stock mutual fund 50 years ago, or you bought a house 50 years ago with the exact same amount of money. So we took $100,000 and we put it in there, and you visit 50 years later, you would find that gold has about a 2% rate of return over that 50 years.
Okay, my friends, I think we've seen enough. I think we've heard enough. Now let's go to the charts just to really put a fine point as to how stupid Dave Ramsey's advice is. As you can see here, I've got a chart in front of me. This is a chart of the gold price, and you can see it goes back to the year 2000. Now, Dave's first dodgy bit of advice was the video I showed you from just 2 years ago. Since that time, gold is up 86%. That poor guy who got told to put his money in a mutual fund has lost out on some epic gains in gold. Now look at the second video. This was from 2020. Since that time, gold is up 110%. Again, some poor guy lost out, and he probably got completely banned because he had his money in US debt, the worst place to be in 2020. Now let's look at Dodgy Dave's advice from 2016 when he said gold is a terrible investment. Since that time, gold is up 200%. And now let's just take it all the way back to the very beginning. Since that time, gold is up 1,200% since the dot-com crash. The S&P 500, Dave's trusty method of investing, stick all your money in the S&P in a tracker or in some bonds. Well, you'd have lost a lot of money compared to gold. It's up 350%. Now remember, the currency has been eviscerated over the past 25 years. All of the gains in the stock market are nominal only. And unless you was in a single stock, which you wouldn't have been following Dave Ramsey's advice because he doesn't invest in single stocks, so you wouldn't have been in Tesla or Nvidia and getting outsized returns. That's really the only way to earn money in the stock market today, is to be a stock picker and to get into a Ponzi stock that's going to get a lot of government subsidies. So basically, government pick the winners and they pick the losers, unless you know what you're doing and you can buy into commodity cycles, which is what I teach over in my investors coaching. But most people don't know how to do that. So they listen to people like Dave Ramsey. And as I just showed you, Dave Ramsey doesn't know shit about the markets, and he doesn't know anything about gold. And that's why he's rich, because he probably gets paid to say those things. Now, let's go to another person who has historically called gold a very bad investment. In fact, he called it a pet rock, and that's Warren Buffett, the Oracle of Omaha, the most infamous, or should I say famous, depending on which way you look at it, investor of the past 50 years, no less. Let's see what he had to say about gold. Okay, so I'm on the website Economist writing every day, and there's some quotes here that the guys collated on Warren Buffett, and these are quotes on why gold is a bad investment. So let's go to 2001. This is Buffett's letter to his shareholders, and he said the following: gold has two significant shortcomings, being neither of much use nor procreative. True gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for an eternity, you will still own 1 ounce of gold at its end. But I would argue that if you own 1 ounce of gold, you actually still have it at the end of eternity. You don't have something like the Great Taking come along, or the collapse of the markets, or have some company just go out of existence, which has happened to pretty much every company in existence over the past 500 years. Some of them still exist over the last 80, 90 years, but they're not exactly doing much anymore. I'm talking like General Motors, for example. But go to the dot-com crash. Pets.com, where are they today? They're nowhere. There's many companies that just went out of existence entirely, but the gold didn't, and that's the point. So he's looking at this from the wrong perspective. But let's see what else he had to say. With an asset like gold, basically gold is a way of going long on fear. Now, I would actually agree with him there that gold is definitely an asset people rush into when they're afraid. But what he doesn't say in this quote is what they're afraid of. People go into gold when they're afraid that the fiat paradigm and the Ponzi system is actually going to collapse, because they understand historically that every single fiat currency on planet Earth that has ever existed has always gone to zero. It's disintegrated into the ether, never to be seen again. So when people get worried and they think, well, maybe this is the moment, of course they rush into what historically has always had value, intrinsic value, going back 5,000 years, not going back 50 years, not going back 100 years or 300 years, 5,000 years. Now remember, all of the currencies that we've got today, the majority of them have only existed for 50 years tops, some of them a little bit longer. But in any case, those currencies have collapsed over 90% versus gold, and they're all going to go to zero eventually. So he tells you a little bit of truth here, that people go into gold when they're afraid. But what he doesn't tell you is why they go into gold. And to understand that, you have to understand your monetary history. So he goes on to say, it's been a pretty good way of going long on fear from time to time, but you really have to hope that people become more afraid in the year or 2 years than they are now. And if they become more afraid, you make money. If they become less afraid, you lose money. But the gold itself doesn't produce anything. But that's the point. Gold isn't meant to go up. In a stable monetary system, gold wouldn't go up. The problem we've got, of course, is we have paper money. Paper money that can be created out of nothing, or worse today, digits on a screen that they can just increase the supply of 40, 50% in a single year. And they do that. And gold simply accounts for it. So that's why your 1 ounce of gold keeps going up in price, is because they're destroying the currencies. Now, another thing that Buffett said, and this one is from a few years back, he said, if you offered me the choice of looking at a 67-foot cube of gold, and the alternative to that was to have all the farmland of the country, everything, cotton, corn, soybeans, and 7 ExxonMobils, just think of that. Add 1 trillion of walking around money, call me crazy, but I'll take all the farmland and the ExxonMobils. Now, I understand what he's saying there. What he's saying is, listen, gold is just an asset. It just sits there. You put it in a vault and you don't think about it. Or you could buy lots of productive farmland or companies. That's true. But what we're talking about here is not gold as an investment. Gold isn't there to make you rich. Gold's there to protect your wealth. And if you had all the farmland in a country, guess what? You can have it all taken from you from the government or the military. They can just expropriate it at any time. And that's happened many times in history. What do you think happened when Germany invaded Poland? Well, they took all the land, and that land was now German land. What do you think happened when countries were wiped off the map, like the Austro-Hungarian Empire? Where did that land go to? Well, a lot of it was expropriated. What do you think happened when the Soviet Union took over all of the Eastern European countries? They took all of the land and they expropriated it. This happens all the time. The reason people have gold and the reason they spread it out across the world is to prepare for the potential that their wealth is going to get stripped. Now, where are we today? We're in exactly the same situation where you've got nations setting up to strip you of your wealth. They're going to tax it out of you. They're going to squeeze it out of you. They're going to do capital gains. They're going to do everything and anything to ensure that your money ends up in their pockets. Capital controls are a given. So whilst I agree with Warren Buffett in theory, that's not why people buy gold. So yeah, farmland's fantastic, but it can be taken very easily. And yes, gold can be confiscated, but there's things you can do to protect yourself from that. And you should be doing to protect yourself from that. But yeah, let's go on. He says gold gets dug out of the ground in Africa or someplace, then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility besides being the perfect form of money, Warren. It's the perfect form of money. There is no asset in the world that meet all of the very difficult qualities that you have to meet, the very high standards to become money. It has to be desirable. Across the world, gold has been for 5,000 years. It has to be durable. It has to be something that doesn't tarnish and doesn't corrode and isn't subject to entropy. It has to be something that's divisible. It has to be something that's fungible. 1 ounce has to be worth the same in one country as it is in another country. 1 ounce of gold, if you melt it down or cut it in half, it should be worth half. If you cut it into quarters, it should be worth a quarter. If you double it, it should be worth double. These are very difficult things to find. Also, of course, it has to be scarce. It has to require a lot of time, the finite resources of human time and energy to get it out the ground. That's what gives it its value. So I guess, my friends, what we're finding out is that the people who are experts or claim to be experts, many of them don't know much, if anything, about gold. Now, the question is, are they just saying that because somebody's telling them to say that, because they have to say that, or are they saying that because they truly think it? Well, again, let's go back to the charts for Warren Buffett. Let's see what his company did versus gold, and you can see this is the price of gold versus Berkshire Hathaway going back to 2000. Now you can see Berkshire Hathaway basically did 76% more. So gold's up 1,200%, Berkshire Hathaway 1,276%. Now that's fantastic for Berkshire Hathaway compared to the S&P 500. Remember, the S&P 500 has done only 350%. So Berkshire's done fantastic. However, if you think about it in terms of risk and the sophistication of having to actually go into the stock market, you've exposed yourself to counterparty risk. You've essentially loaned all of those shares as well to the derivatives complex, which people have now found out. So there's a huge hidden risk there. Just because it hasn't manifested, it doesn't mean it's not there. And it doesn't mean it's a smart thing to take on that risk. But in any case, gold just sat there. It's tangible. It can be held outside the system. You can go to sleep at night. You didn't have to do anything fancy. Warren Buffett, yeah, he had to do a lot of work for that. His whole company did. And they only got 76% more than gold over 25 years. So there you have it, my friends. The legendary Warren Buffett, the Oracle of Omaha. He could have literally just taken his clients' funds back in the year 2000, put it all into the pet rock, as he called it, and then just put his feet up, hands behind the head for 25 long years, sat there sipping his Coke, getting diabetes, eating his McDonald's, not employing a single person because he didn't need to. He just had to put his gold in a vault, and he would have had the same returns as he got for all of the time, effort, painstaking effort to keep that portfolio running. So what does that tell us, my friends? Well, it tells us that Warren Buffett, like Dave Ramsey, doesn't know shit about gold, but it also tells us something significant has been happening since the year 2000. Now, granted, from 1980 to the year 2000, which was a 20-year period, gold didn't perform. Now, why didn't it perform? Well, that's because there was a financial reset. The financial reset began with the ending of the Bretton Woods system in 1971. And from that moment up until 1980, gold went up 2,300%, almost perfectly to the debt to gold ratio that the US had after the previous financial reset in 1933. Now, after that, gold stopped performing because, of course, the US engineered the petrodollar, and the petrodollar forced nations to sell their gold holdings, central banks to sell their gold and go into US treasuries so that they could support the Ponzi scheme, but also to buy oil and commodities. And that's why gold fell up until the year 2000. But at that point, the system started to unravel. The stock market was in a mega bubble. Housing was in a mega bubble. And the only way they could fix it from that point onwards was to debase the currencies en masse at a pace we had not seen before in the modern era. And that's precisely what's been happening since 2008. It sped up. And then since 2020, it sped up even further. So now we're seeing gold take off like a rocket. And that's not because gold is a fantastic investment. It's because it's a fantastic wealth preserver with investment like properties going into a reset, because you can buy a lot more of the other asset classes as gold outperforms then and outpaces inflation. So whilst these other asset classes are going up nominally, yeah, you're going to see housing continue to go up nominally. You're going to see the stock market go up nominally. But in real terms, they are absolutely collapsing versus gold. And I always give examples of this. So I'm going to leave it there for this episode. If you would like to learn more about this, you can check out my most recent Substack article. No, actually, it was about three articles ago. But you can go back and find that. It's talking about the gold revaluation phase 1 and phase number 2. I'll leave a link in the description. As always, a huge thank you to my Patreon and Substack members for supporting the content. And also a thank you to you for listening. Please give it a like, a thumbs up, and a share if you think somebody else needs to learn a little bit more about precious metals. In closing, take care of yourselves, God bless, and I'll see you in the next one.